Hello, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of June 30th, 2024. Thank you very much for joining me. Despite some weaknesses at the headline level, underlying U.S. economic momentum remains solid in the first half of the year. At the same time, progress on inflation has been slow, while the labor market has continued its gradual normalization. Moving forward, a resilient consumer should allow the U.S. economy to sustain a soft landing into next year. However, with still elevated geopolitical tensions and an upcoming U.S. election, risks remain that are worth monitoring. Meanwhile, sticky inflation has forced the Federal Reserve to reassert its hawkish tone. At its June meeting, the Fed's updated dot plot showed that it expects to deliver just one rate cut this year, down from the 3 cuts they projected in March. While they have delayed rate cuts, the Fed has begun to slow the pace of quantitative tightening. Elsewhere, other global central banks have begun to ease policy, and a widening gap in short-term interest rates between the U.S. and other major developed economies could maintain the U.S. dollar in an elevated position for some time to come. Bonds have rebounded after a challenging start to the year, while equities have maintained their upward trajectory and notched multiple new all-time highs during the second quarter. Moving forward, broadening earnings growth should support a more inclusive stock market rally, while investors may want to use this extended period of higher rates to lock in attractive yields in fixed income. In this quarter's Economic and Market Review, we assessed the recent performance of the markets and economy, considering trends in growth, jobs, and inflation in the U.S., and how these trends are shaping the outlook for monetary policy. This is followed by comments on growth from around the globe. Finally, we consider the implications of all this for those investing across asset classes and highlight the importance of getting invested even with markets near all-time highs and actively managing risks within portfolios. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. Feel free to pause the video to read the slide. Join me while I discuss these topics and more. In the first quarter, with real GDP falling from 3.4% annualized in the fourth quarter to 1.4%. However, after stripping out net exports and inventories, which are the most volatile major components of GDP, underlying economic momentum still looks solid. Consumers have displayed impressive strength, supported by a tight labor market. That said, we do see some signs of stress. Sentiment remains suppressed, while spending on durable goods has slowed in recent months, a sign of mounting stress on lower-income households. Auto and credit card loan delinquencies have risen above their pre-pandemic levels, but despite this, a still tight labor market and rising real wages should continue to offset dwindling excess savings and tighter credit conditions, and consumers should help extend this expansion into next year. Business spending has been surprisingly resilient over the past year, largely due to healthy corporate balance sheets, government incentives, and surging demand for AI-related technologies. Tailwinds from AI spending and related technologies and the federal government should continue to partially offset the impact of higher interest rates, although any slowdown in corporate profits could constrain growth in capital expenditures. The housing market has stabilized but remains depressed, and while elevated mortgage rates will limit any significant reacceleration in the sector, tight supply suggests a recovery in activity is more likely than another meaningful decline. International trade may be a slight drag on the economy, as a still strong dollar weighs on exports, although prospects for global growth are improving. Meanwhile, increased spending on public infrastructure and stronger hiring should continue to support government spending. Overall, the U.S. economy looks set to maintain its soft landing trajectory into next year. That said, with an upcoming U.S. election, high policy rates, and elevated geopolitical tension, plenty of risks remain that could cause the U.S. economy to falter. While the labor market has normalized from its post-pandemic boom, job growth remained solid in the first half of 2024. The unemployment rate edged up to 4% in May, but still marked the 30th consecutive month of unemployment at or below 4%, the longest such streak of low unemployment since the late 1960s. Despite fears of an economic slowdown, strong growth in the U.S. labor supply has allowed employers to hire workers and narrow the gap between supply and demand. After falling sharply during the pandemic, labor supply in the U.S. staged an impressive recovery over the last 2 years, largely due to increased immigration. In fact, in fiscal year 2023, Immigration Services approved over 2 million initial applications for employment authorization, a 70% increase from a record 1.2 million in fiscal 2022. With this surge in migrant workers, employers were able to fill job openings without applying upward pressure to wages, helping to explain why strong job creation hasn't sparked higher inflation. Importantly, a strong recovery in the labor force participation rate has also boosted labor supply. While continued aging of baby boomers into their retirement years has left the overall labor market force participation rate below pre-pandemic levels, participation amongst the working age population, or those aged 18 to 64, has fully recovered its pandemic losses. Moving forward, tighter labor supply, falling job openings, and solid productivity growth could slow the pace of job gains. That said, a backlog of migrant workers waiting to be integrated into the U.S. economy suggests that employment growth could remain solid and the unemployment rate should stay low. Inflation has made meaningful progress toward the Federal Reserve's 2% target. However, that progress has stalled in 2024, and headline CPI has remained range-bound between 3% and 3.5% since last October. While the journey back to 2% may take longer than expected, there are still disinflationary forces that should allow inflation to resume its downward path in the second half of the year. Core goods prices have continued to trend lower in 2024 as supply chains have remained well managed even with recent conflict in the Middle East and should remain well behaved. On the more volatile components, energy prices have rebounded in recent months due to higher gasoline prices, while food inflation has remained mild. Moving forward, slow global demand limits the likelihood of a surge in either of these categories. That brings us to the stickier segments of inflation, shelter and auto insurance. Shelter inflation accounts for over a third of the CPI basket and has held stubbornly above its pre-pandemic trend. In fact, the measure has grown by 0.4% or above month to month for 7 consecutive months. That said, shelter inflation should continue to follow real-time measures of market rent back to more normal levels. Auto insurance has been another source of hot inflation and is currently rising by over 20% year over year. Fortunately, prices here actually fell on a monthly basis in June, suggesting that pressures are improving, not worsening. As the rollover in vehicle and auto prices feed through the data, this trend lower should continue. Overall, inflation should continue to ease throughout the balance of 2024 and into 2025. While the ride down may take longer than expected, the Fed should feel reasonably confident that inflation can fall close to their 2% target by the middle of next year without further policy tightening. The resilience of the U.S. equity market in 2024 has been very impressive. Despite a sharp hawkish repricing in policy expectations, stocks showed a few signs of slowing, and the S&P 500 is up about 15% this year. This rally has remained narrow in nature, and the Magnificent Seven continue to lead the charge higher. In fact, this cohort of stocks is already up over 30% this year, while the rest of the index is up just 5%. That said, strong performance from the Mag 7 isn't without reason. These companies were large beneficiaries of excitement around artificial intelligence and were responsible for all of the S&P's earnings growth in 2023. While this dynamic continued to play out during the first quarter 2024 earnings season, other companies across sectors are expected to see earnings improve in the coming quarters. As 2024 progresses, earnings growth should broaden out to the rest of the index, supporting a more inclusive and sustainable equity market rally. U.S. equities have been on a tear over the last year and a half, gaining more than 40% since the start of 2023. However, the concentrated nature of this rally has created divergence beneath the surface. While valuations at 21 times forward earnings look concerning, there are still plenty of attractive opportunities outside the select few mega-cap stocks that have dominated this rally. On the left side of the slide, we compare the price-to-earnings ratio of the top 10 stocks in the S&P 500 to that of the broader index. The historically narrow nature of the recent rally has left the top 10 stocks significantly more expensive than the broader index, while the remaining stocks look cheap comparatively and are trading closer to their long-term average. Indeed, index concentration is not a new phenomenon, as the weight of the top 10 stocks in the S&P 500 has been rising since 2016. However, while the top 10 stocks dominated earnings growth last year, their earnings contribution hasn't kept pace over the long run. With the top 10 stocks now representing roughly a third of the index but only a fourth of the earnings, there appears to be a strong case for investing in the rest of the index. If economic growth remains steady through the rest of 2024, as we expect, gains should broaden out beyond the largest names as the market grinds higher. In this environment, an active approach can help identify those companies with high-quality earnings and attractive valuations that are being overlooked by the market. Resilient economic activity and solid earnings growth have powered the S&P 500 past over 30 new all-time highs so far this year. Many investors feel like they missed the boat, leaving them on the sidelines waiting for a pullback. While investing at an all-time high can be daunting, this page shows that even at all-time highs, markets can still be attractive. On the left, it shows that the S&P 500 price index in gray and mark each all-time high that set a market floor or an all-time high from which the market has never fallen more than 5% in green. If an investor had planned to wait for markets to retreat from all-time highs before investing, there would have been many instances since 1950 in which an investor would have missed the boat and never seen a better entry point. On the right, we show the average cumulative total return for the S&P 500 over different time horizons when investing at new highs versus investing on any given day. Returns generated from investing on any given day are similar to returns from investing at all-time highs. In fact, for most of these time horizons, returns were more favorable when investing at all-time highs. With momentum playing an increasingly important role in today's market, investors sitting on the sidelines should remember that strong performance usually begets more strong performance. Stalling progress on disinflation has forced the Federal Reserve to reassert its hawkish tone in recent months. While the Fed continues to have a bias towards easing policy, it needs more evidence that inflation is trending in the right direction before cutting rates. At its June meeting, the Federal Reserve left rates unchanged in a range of 5.25% to 5.5%, and they reduced the number of expected rate cuts in 2024 from 3 to just 1, although they did add 1 cut to the 2025 forecast. In its updated projections, the committee increased its headline and core inflation forecast for 2024 by 20 basis points and left its growth forecasts unchanged. This suggests that the committee still expects a soft landing, but also a slower path down toward its 2% inflation target. While the Fed didn't deliver rate cuts in the first half of the year, it did slow the pace of quantitative tightening. The Federal Reserve is now only letting $25 billion in treasuries mature off its balance sheet each month, down from $60 billion, while they left the mortgage-backed securities cap unchanged at $35 billion. This should leave the Fed with much larger Treasury holdings than before the pandemic and help hold long-term interest rates down. Moving forward, with market expectations and Fed messaging very much in sync, it would likely take a meaningful change in the economic outlook to trigger any sharp movements in long-term interest rates in the months ahead. Bonds struggled in early 2024 as investors reconsidered the outlook for rate cuts. That said, as market and Fed expectations have converged, bonds have rebounded and recent performance has stabilized. Still, the move higher in rates has dramatically improved the income offered by fixed income, and investors now have an extended opportunity to lock in higher yields. This slide shows the yields across fixed income sectors relative to the last 10 years, and nearly all sectors are trading well above their 10-year median yields. Simply sticking with core fixed income provides attractive yields above 5%, while leaning into riskier asset classes like high yield can provide yields of almost 8%. While bonds may not provide meaningful capital appreciation without any major shock, they should help diversify portfolios if lower rates coincide with recession. Moreover, higher yields offer an attractive yield cushion that can help offset losses if rates move in the other direction. This potential for asymmetric return in bonds won't last forever, underscoring the importance of leaning into fixed income while yields are at these elevated levels. This slide illustrates what kind of returns we can expect from fixed income over the next 5 years. The slide plots the starting yield of the Barclays U.S. Aggregate Total Return Bond Index and then the subsequent 5-year return. And you can see there's a clear trend. The higher the yield, the higher the return. According to the R-squared, yield alone explains about 88% of the AGG's return over a 5-year window. So if we look at where we are right now with the current yield of 5% for the AGG, the chart predicts an annualized return of 5.2% over the next 5 years. So rather than give up on fixed income because yields have moved higher, it's actually arguing to lean into a core fixed income allocation more. After a sluggish ending to 2023, prospects for the global economy appear to be turning a corner in 2024. Countries that have done well, like the U.S. and India, should continue to do so, while those that have lagged, like Europe, should see better times ahead. Economic surprises in Europe have turned positive in recent months, a sign of too much pessimism toward the region. Activity has been supported by higher consumer confidence due to rising real wages and stabilizing manufacturing activity. In China, the real estate slump continues to hamper growth, and while activity has gained momentum in recent months, incoming data on employment and inflation continue to look weak. That said, as fiscal support turns to focus on housing, growth should stabilize around 5%. Elsewhere in Asia, Taiwan and Korea should benefit from renewed global demand and tech-related exports, while favorable demographics and economic reforms should continue to feed momentum in India. Overall, this year should mark a turning point for the global economy, and while the recovery may not be even across countries, brighter times are ahead. With U.S. consumer activity expected to slow, narrowing growth differentials should highlight plenty of attractive opportunities across global markets. A long cycle of U.S. equity market outperformance over international markets has left many U.S.-based investors nervous about allocating abroad. However, there are attractive fundamental tailwinds around the world that are difficult to ignore. In fact, well over half of the 50 top-performing companies this year are located outside of the U.S. This slide aims to highlight opportunities that investors may be missing. In terms of earnings growth, the U.S. has been the standout market, although prospects in other countries are improving. For example, higher wage growth in Japan could create a positive wage price spiral, which should boost company revenues and improve Japan's sleepy economy. Moreover, continued focus on improving corporate governance could generate additional multiple expansions. In Europe, stabilizing manufacturing activity and an improving economic backdrop should support earnings. Peak pessimism toward China appears to be behind us, and emerging market earnings estimates have improved on the back of AI tailwinds and optimism for a turn in the electronics cycle. Strong performance across international markets has pushed valuations higher over the last 6 months. However, in both absolute terms and relative to their own histories, international markets could look attractively priced compared to the U.S. Given that some global central banks have begun easing policy while the Fed is likely to remain on pause, a strong U.S. dollar could weigh on returns for U.S.-based investors. Even so, favorable valuations, an improving economic backdrop, and positive fundamentals should highlight plenty of opportunities around the globe. Goldman Sachs analysts project that the big tech companies are set to collectively spend over $1 trillion on artificial intelligence over the next 5 years. Capital spending, or CapEx, for AI includes the construction of expensive data centers, which are physical locations that store computing machines and their related hardware equipment. Hyperscalers like Microsoft Azure, Google Cloud, and Meta Platforms build and use these data centers to develop and operate AI. As we can see on the bar graph on the left, spending by hyperscalers has been increasing over the last couple of years and is projected to increase dramatically in 2024. However, other significant AI expenses are missing, such as the higher energy usage and spending in the form of IT salaries, considered operating expenses, or OPEX. The largest adopters of AI, not surprisingly, can be found in the information sector, with 22% of information companies projected to be utilizing AI by mid-2024. Next is professional and technical, followed by education, real estate, and finance and insurance. As AI capabilities increase, we should expect to see much wider adoption in the future. Like AI, cryptocurrencies also have high energy demand. Older cryptocurrencies like Ethereum and Bitcoin use an energy-intensive proof-of-work process that involves solving complex mathematical problems to validate transactions and add them to the blockchain. This requires a significant amount of computational power, which in turn requires a substantial amount of electricity. However, newer cryptocurrencies like Ethereum 2.0 use the proof-of-stake process, which avoids the computational puzzle and reduces energy consumption significantly. Even so, electricity demand of cryptocurrencies is expected to increase like that from data centers. As an example of energy consumption projections, let's look at the future power demand forecast for Dominion Resources, a utility serving 6 million customers in 15 states in the Mid-Atlantic region. The left chart shows the annual demand forecasts, which have been consistently unchanged over the last couple of decades. However, 2022 and 23 show significant increases due to the rise in data centers. The right chart breaks down energy consumption by the industrial and residential sectors, which are relatively flat through 2038, and commercial, which is projected to take a steep increase over the next several years. Within the commercial sector, most of the increase stems from its component, data centers. Constellation Energy estimates that the AI revolution could require more power in the U.S. than the future electric vehicle fleet. If that's the case, the productivity benefits from AI may not be large enough to offset the increased power load. The bottom line is that the rise of AI could drive additional investment in energy, including fossil fuels, hampering efforts to transition away from them. So as we see, future energy demand for data centers is quite formidable. It has researchers discussing new processes to package semiconductors in a way that drives more efficiency or more performance for the amount of power that they use. As we wrap up this quarter's review, let's examine the matrix as of June 30th, 2024. U.S. large-cap equities continue to dominate the landscape, achieving a robust year-to-date return of 15.3%. This performance continues to lead the pack, much like last year, followed closely by emerging market equities with a return of 7.7%, developed market equities at 5.7%, while the traditional 60/40 stock bond portfolio returned 5.5%, and commodities were up 5.1%. However, not all asset classes fared as well. Fixed income and real estate struggled to maintain positive momentum, posting negative returns year to date. This underscores the importance of a diversified portfolio, as these two asset classes serve as a reminder that risk management and strategic asset allocation are crucial in navigating the ever-changing financial landscape. And there you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's video. As always, please feel free to reach out to me to review this and more.